now, Talk Real Estate with Sharon McNamara, sponsored by Boston Connect Real Estate Services.
Hi, I'm Sharon McNamara, and you are listening to Talk Real Estate Roundtable. Let me share a little bit about my background before we get started. I am the broker-owner of Boston Connect Real Estate, a boutique real estate firm that is home to over 30 real estate sales and marketing consultants who service home buyers and home sellers throughout Boston, the South Shore, the South Coast, and Cape Cod. Our firm takes pride in assisting our clients in the next chapter of their lives by taking a holistic approach to their real estate endeavors. We believe that every move should be a moving experience. Every week, my real estate team member Mary Baker and I, along with the director of Boston Connect Real Estate, Melissa Wallace, provide you with our unique marketing approach to selling homes and share with you our expertise in navigating the home buying process. We like to mix it up sometimes, so not only will you hear our perspective on real estate topics, but you will hear the expert thoughts and opinions of some of our real estate agents at Boston Connect Real Estate and the preferred professionals that we trust. Be part of our roundtable. If you have any questions during the show, please call 781-837-4900. We'd love to talk real estate. Follow us on Facebook, Instagram, and wherever you listen to podcasts at Talk Real Estate Roundtable. If you would like a one-on-one consultation with me and my team or one of the dedicated agents at Boston Connect Real Estate to discuss your real estate needs, you can connect with us at bostonconnect.com or 781-826-8000. Now, sit back, relax, take good notes, and let's talk real estate. And hello to all my South Shore neighbors. You are listening to Talk Real Estate Roundtable here on a Tuesday evening. I am with my sidekick here, Melissa Wallace, in-house here. Hello, hello.
Hello.
I am so happy to be here with you. I haven't been here on a Tuesday in a long time, but we have our Saturday thing going on, but I noticed you got your donkeys there and didn't get me one, but that's okay. We have a couple of guests that are going to be joining us tonight as well. We have, the soon-to-be Mr. and Mrs. Horton joining us. Yay! Mary and Sam are with us. So, of course, Samuel Horton is a full-time real estate agent here at Boston Connect Real Estate, as well as Mary Baker, who is our team member here. And again, the show is sponsored by Sharon and Mary Real Estate Team, as well as Boston Connect Real Estate. And the wedding is coming up 2 months from today, right? Or tomorrow. 2 months from yesterday. Yep, 2 months from yesterday.
So we're actually Zooming. I'll let everybody know. We're Zooming in tonight because we have a lighting company coming to our house at 7 o'clock. And we had to run out.
Yes, awesome. And we also have someone who is with us often. Jazmine Glasgow is with us from Maritime Mortgage. Hello, Jazmine.
Hello, hello. Thanks for having me back.
I am so happy to have you, and you're such a trooper. I texted you this morning, and I was like, I need your help tonight, and I'm hoping that we can get our other guest on. I don't know if somebody else has to send him the link again, or maybe somebody can do that, and we can try to figure that out, how to get Mark Eitel on with us. He is MrMortgageRadio.com, and listen to him frequently over in Clubhouse, and I know that Jazmine does a room with him as well over in Clubhouse. And we have Larry in the WATD studios. Hello, Larry.
Hey there, how you doing?
Wait, I'm doing good. I haven't seen you in a while, so you'll have to pop on over and say hello.
I wanted one tidbit on real estate. A house, and my neighborhood. There's a one-bedroom house on my street. Went up for sale and was sold within a week.
Yeah,
that's amazing. And it needs a lot of work. It's very dated.
You should have bought it.
I didn't have $360,000 to buy a one-bedroom house on my street, though.
One of the reasons why we have Sam Horton on with us tonight is because he works with a lot of investors. And the topic that we have tonight, we thought maybe pull him into the conversation a little bit, too, to see how that will maybe impact people as well. And then, Larry, I want to actually talk to you because maybe you can help me out next Saturday, May 6th. I want to give a little plug, not this Saturday, but the following Saturday. We're going to have Chief McDonald on with us and Chief Viveros. Chief McDonald is from the police department in Pembroke, and Chief Viveros is from the fire department. I sit on the public safety building committee. And I'm doing a big show with them on Saturday, and I'm trying to get Tim Cruz and McDonald. What's his first name? Joe McDonald. Do you think you're a better interviewer than me? Maybe you should come and help us that day. What do you think?
Get everybody. They all know me. The sheriff knows me, and then the DA. Yeah.
All right. Well, maybe we
see
can go
each other
in
all the time.
I need your help. All right. So I'm going to talk to you off.
Keep me in the loop.
I will. Thank you,
Alrighty.
Larry. You're the best.
All
And happy to have you here these last few weeks while George has been on vacation out in Europe. So that's fun. So it looks like our other guest has joined us. I'm not sure if he can hear us. Can he hear us now? Yay.
I can.
Awesome. So we have Mark Eitel with us, MrMortgageRadio.com. And I was telling everybody that I know you from Facebook. I'm not Facebook, from Clubhouse. And this is such a topic that has sort of been fueling a lot of fire. I actually was just watching your TikTok, Mark, and that was fabulous. So I got off of TikTok for a while just because everybody told me China was following me. I didn't know why they would want to follow me, but I said, oh, maybe I'll get off TikTok. I just went on just to watch Mark's video. So
I appreciate that. And you're not talking about that video where I was dancing with the cats in the kitchen. That's not the video you're referring to.
That is actually the one I was watching. No, I was the one that is all of the talk and rage right now. And I know you know Jazmine, so I took the liberty to ask her to join us tonight too. So, and again, I said to you actually yesterday in Clubhouse, and I said to Jazmine this morning, I feel very uneducated when it comes to all of this. So that's why I'm bringing on the pros to ask the good questions and to sort of dial it down, dumb it down for me and all of our WATD listeners. And Mark, just so you know, Mary is, I don't know if everybody's in the same place, but Mary's up in the top left-hand corner with her fiance, Sam Horton. Mary is my team member as well as Melissa. And Sam and Mary are getting married in 2 months. And Sam works with a lot of
family history.
I know. Yeah. And I don't know, anyway, Sam does he does a lot of investments. So he brought up some really good questions if this is going to sort of slow down the roll with them as well. So we'll dive deep into that. So Jazmine, Mark, I'm going to let you guys sort of start the process. Let all our WATD listeners know what we're discussing tonight.
Yeah, I'm excited to jump in, and thank you for the invitation. I love that I'm with the babes of Boston. Joining the
You hear that,
group.
Sam? I love
I'm
that.
sorry, it's Sam too, right? There's a lot of enough testosterone to balance it out tonight. But no, this is awesome. And it's interesting, and I couldn't be happier that Jazmine's with us tonight because I definitely respect her voice in this space. So I'm super excited to be with everybody tonight. But you're right, this topic has gotten so much play of late. And it's interesting because Jazmine and I were talking earlier today. Industry-wide, we've been talking about this for months. And suddenly it gets on Fox headlines and Washington Post and TikTok, and then everybody's running rampant with it. So I'm glad that you're giving us a little bit of space to discuss this tonight because it's not as bad as people think it is. And I just want to touch on a few points that are being misquoted or misrepresented, and then I want to toss it over to Jazmine for more details. But there are 4 things everybody seems to be missing with these loan level pricing adjustments. And the first thing is, guys, these aren't new fees. These have been around since 2008, and they were enacted to offset some of the losses that mortgages were suffering after the crash. So it's not a brand new policy, but they're changes to existing policies. And there's some unfair reallocation of risk, which has gotten everybody's attention. So the one big misconception is that this is a new fee structure. It's just adjustments to an existing one. So I wanted to get that out there. And then the second thing people seem to be missing is these aren't lump sum fees that are being added to your closing costs. So when you see that matrix that we've all been referring to lately, and you see a 3/4 of a point increase or a 5/8 of a point increase, that's not a flat fee that's being charged at closing. It's being absorbed in the interest rate. And that's the reason why most people never knew these even existed, is because they're built into the interest rate. And then it doesn't affect any existing mortgages. It's for new mortgages that are originated and delivered to Fannie and Freddie after the 1st of next month. So anything that is being rate quoted today, these fees are already built in. And then lastly, yes, there is definitely a Robin Hood effect, right? Take from this group to subsidize that group. And we can get into the right and the wrong and the policies and all of that. But the reality is it's not a dollar for dollar exchange. So where some borrowers on that matrix are receiving a 1.75, almost 2 full percentage points of a discount compared to what they were paying last month, it's not being charged to someone else in that bucket a full 1.75%. So there's still the misconception that I'm paying more as a high credit score borrower, so a low credit score borrower can pay less. And that's true, but that's compared to what we were each paying last month. There's still a big difference between the high credit score borrower is receiving lower fees, considerably less than the lower credit score borrower. Now that all of that's out there, we can definitely discuss the details of it all, but I just wanted to touch on those things. Not new fees, not a lump sum fee, only for new mortgages moving forward. And there's still a lower fee to a good credit score borrower than a lower credit score borrower.
Can I back us up a little bit and define what's happening in the media?
Yeah.
Go ahead.
Because I feel like so one thing Mark and I are super guilty of on the Mortgage Roundtable, we geek out real hard,
I love
real
that.
fast.
I love it. I love listening. So,
And so the headlines are reading, and I'm just going to take these Mortgage News Daily. Is there really a new unfair mortgage tax on those with higher credit? Reason.com, borrowers with high credit scores penalized under new federal mortgage fee plan. Newsweek, Biden raises costs for home buyers with good credit to help risky borrowers. New York Post, how the U.S. is subsidizing high-risk home buyers at the cost of those with good credit. So that's what the media is saying. That's what's pushing out. Mm-hmm. Now, when I started seeing this last week, my first reaction was, guys, you are so late to this party. Mm-hmm. You are so late to this party.
But why? But tell me why, Jazmine, because you know what? I think that this is one of those things where we feel like it was hidden for a reason, because if we didn't know about it before, maybe we wouldn't have found out about it now. It was almost like it was leaked.
Yeah, it's because no one was listening to Clubhouse and Mark.
Other than me.
Mark and I we've been battling this out because him and I have some really strong feelings about this. And we've been talking about this for some time now. And it's for the industry experts. That's what people need to understand. This is not something like you're seeing across the board. The fact that people aren't angrier that credit reports are almost doubled, tripled with some companies, that is a direct consumer problem. Mm-hmm. Consumers are going to be paying that direct fee because it's a pass-through, right? This is on the back end. So what you don't realize is when you as a consumer, as a borrower, as a home buyer, as a homeowner, take a mortgage, you are getting the iceberg tip of the situation. Mm-hmm. What's happening below the water is the pricing that comes from Fannie Mae, these rates that are pretty much bundled up and sold on the secondary market to investors, sold into your 401k, sold into your 403bs. Like these are investments on a wider scale, right? And you're not seeing the money come down from the investor. Everyone takes a little piece, and that ends up being what the consumers get. Everyone has always been under the impression higher credit scores, larger down payment means lower rates, right? But no one's known why. Why has that been the case? Well, this is the definition. These are the loan level pricing adjustments. That's what we're talking about here. They're LLPAs for short. And these pricing adjustments are all of the indicators on a loan on how we price out interest rates. So a 6% rate isn't a 6% rate for you. It's not a 6% rate for me. It is all the different factors. And that's why when someone's like, I want to know what the 30-year fixed rate is today. I said, okay, well, you need to tell me, need to tell me everything about your profile. I need to know, is this your primary? I need to know what your credit score is. I need to know, is this a 2 to 4 unit property? All these buckets, all of these adjustments have always existed. Now, not all of them. There are a couple new ones. Oh, I love the heat sheet. The heat sheet, Mark. So those on Zoom.
You have to unblur your background. So
I know. I'm sorry. I'm so technically challenged. But guys, this is what caused all the buzz. Mm-hmm. And to Jazmine's point, this is so technical that it goes unnoticed, right? So in the height of all the refinancing boom, when rates were in the high ones for 15-year and 2s and 3s for everybody else, they enacted a loan level pricing adjustment for all refinances, and nobody knew it because it was built into the rate. And that's why we, as an industry, meaning the lending profession, we were pushing back when this was announced in January. Guys, this is, unnecessary. And we can argue until we're blue in the face, but it didn't make sense to anybody until it was on one sheet of paper with this pretty color scheme, and the red numbers were there we go, perfect. So guys, if you're watching, you see that this is a heat map matrix, and it shows the adjustments. Green is receiving a price reduction, red is receiving a price increase, and it's clear that a larger down payment with a higher credit score is receiving the largest increase. The lower down payment and the lower credit score is receiving the biggest decrease. But you don't see these numbers as flat fees because they're built in to your interest rate, so they go unnoticed until this beautifully illustrated heat map started making it around the internet, and everybody said, wait a minute, an 80% loan with a 740 credit score is paying a higher interest rate than their perception is the lower credit score, which is a misperception, but higher than yesterday, which is why everybody's up in arms, because we're already, as consumers, experiencing the increasing interest rate environment because of all of the economic factors. And here's an arbitrary fee adjustment enacted by the government. And I think it's really easy right now, because we're in such a heated political environment, for everything to feel like a Robin Hood move, rob from the rich, give to the poor. And this illustrates that as such. So me personally, I'm super glad this is getting all the attention, because fundamentally, as lenders, we're supposed to provide equal access to capital to everybody. And we're even governed in how we charge people. So we can't charge a lower credit score borrower that has more challenges a higher fee structure than somebody that's easy and squeaky clean and putting a big down payment down. But this matrix clearly indicates that the government is doing just that. So if they enact legislation post the housing crash, Dodd-Frank, which dictates how, I'm sorry, I'm getting excited, which dictates how we charge people, then how can the government fly in a completely contradictory direction? So I didn't mean to interrupt, but I think this is why, to answer your question, it's gone largely unnoticed in the past, but this is a great visual representation of what's going on, and people really latched onto this.
I know Mary had a question for you too, and I have to tell you, Mark, of all the different conversations we've heard, remember I had brought up a couple of different scenarios, like, with this whole, the lock-in effect that we have right now, how I think it's going to make it more difficult. I think that people, as Jazmine said, they listen to the media, but that's generally all it takes for people, Jazmine, and they're not listening any further than that, right? So it's just going to piss off a lot of people. I'm sorry, WATD, that I just said that. But Mary had a good sort of approach to this as well that I hadn't heard before. And one of my things, though, Mark, that you said is, it isn't necessarily taking from one to give to the other, but it certainly feels like the people who are keeping their credit score in check. And I asked Jazmine how much I worry about my credit score. Like, my husband and I have a contest every month, like whose is better. It almost feels like...
I will not say who's winning.
It's always the lady, because we do the same thing in my house. I don't know how she's always higher, but she is.
I'm on nothing. That's my father. My father's credit. Anyways, I'm on my father's credit card. I'm getting off of that. But with that, I just feel like people you're rewarding good behavior is generally rewarded, not bad behavior.
Well, and that's a brilliant point. And then I'm going to stop because I know there are questions, but you're right. And I think that's why this is such a spirited and passionate conversation, because it's clear that the better credit model, right, which makes sense logically, there's less risk. So if you're talking about pricing adjustments based on risk, there's zero logic in a high credit score, 20% down payment, because guys, the 20% down payment establishes an 80% equity ratio. And that's where lenders have established a comfort level for risk. That's why anything over 80% requires mortgage insurance, because that insurance insures the lender against that difference, anything over 80. So if you tell me my whole life that I need to put down 20% because that's the comfort level, the risk tolerance of the lender, and I'm going to get great rates, and then you say in this matrix, these adjustments, that we're now going to charge them more. And that's all people hear. It's more than yesterday. It's not more than the person that's got the lower credit. But to get back to your point, you're right. It does feel like a subsidy because all of these fees go into the same bucket. And that bucket is used to offset the expenses of originating and servicing and buying mortgage-backed securities. So they're taking more from one group of people and charging less to another group of people, and it sure feels like a subsidy. But it's interesting because I don't think it helps the people, and I know Jazmine's got some great thoughts on this because we were talking about it earlier before we got on the air. It doesn't help the class of people as much as you would think it does at the cost of the people that it's affecting negatively. To say that politically correctly, there's better lending options available to somebody with a 619 credit score and 5% down payment. Exactly. I'm going to let you run with that because you and I are totally aligned with that.
Let Mary sneak in. Yeah, let Mary sneak in there.
Well, no, so I truthfully didn't know any of this until 7 o'clock this morning when everybody was in a group text message and, my world kind of blew up. And I was like, oh my gosh. All I could think of was, if we're charging the people who have the higher down payment more on a percentage basis, is it just to make more money over time? And in my silly brain, Jazmine knows this about me, I'm not the numbers person at all. So I was saying, okay, so if fees wise, closing costs for somebody who is 3% down, FHA product was $10,000, but somebody who had 20% down payment or and was conventional, they're $20,000. Is it just so they'll finance more and over an amortized 30-year mortgage get more money on their
brilliant.
So great conspiracy theory.
Observation.
I love it.
Hey, listen.
I was like, this is my silly brain. Like, I know 10,000 to 20,000 in closing costs or fees or whatever. Is it just to finance more? Is that the motivation?
Whether it's a conspiracy factor or not, Jazmine, the truth is I want to know, is the 20% down buyer, and this is where Sam's going to come in, is that 20% down buyer going to say, well, screw that, I'm going to just put 10% down and I'll put 10% in stocks?
Well, let me break this down into a few things. So
Okay.
some things were said. The first place I want to start was Mark, who said the rate from yesterday versus the rate to tomorrow. This is the rate as of January or February. Once all of us knew on the other side of the table knew about this started coming into rate sheets. So this is anything delivered to Fannie and Freddie, meaning it has already closed, it's been packaged up, it's been sold. So these rates, all this pricing has been in the works for over a month, at least over a month, 6 to 8 weeks. It's already been into effect and no one's noticed. So that 20% buyer isn't going to become a 10% down buyer because you're still in a better position with a higher credit score and a lower down payment, borrowing less, getting one step closer to that financial freedom. And people are managing that payment. What they're looking at is that payment. And they're not looking at, they're not considering, oh, well, this is going to cost me 25 basis points more in my closing costs. Like, they're seeing a rate. We're saying, okay, this is what the interest rate is. This is what the cost is for that interest rate. This is the no point interest rate. Here are your options. What do you want to do? They're not like, oh, hey, what about that loan level pricing adjustment? It's already built in. They're already absorbing it. They've been absorbing it for weeks now without notice because it ends up being, at the end of the day, a decision whether you're going to pay points or not pay points and take the higher rate. And the spread, I want to be very clear on this. It's not crazy in regards to the change for these higher credit score down payments. If we open up that map again, and we look at the 20% down payment with the say 720 FICO score, we're talking about 25 basis points difference. And a 25 basis points is 1/4 of a point. A point is 1% of your loan amount. So we're talking about, $250 for every $100,000 borrowed. Now, it's not going to be the biggest swing if you're buying a home in Massachusetts for $600,000 and you're already putting down $120,000, because at that point, that extra $1,000, it's already considered as part of your closing costs, or that interest rate is already built in. So people aren't seeing it. they're only upset because they're being told to be upset, if that makes sense. And I'm not saying it's unjustified, the being upset, but I think it's doing a couple things. And these adjustments are across the board. First, that lower credit score adjustment, those pricing adjustments were insane. They were really, really high. So those coming down makes a lot of sense because we're not in a high foreclosure time. We're not seeing a lot of delinquencies. That fund might be overfunded, honestly. So that coming down on its own isn't a problem. Them increasing it for those higher credit score, credit risk, that's that Robin Hood. So lower credit risk, higher credit scores, bigger down payments. That's that Robin Hood effect we're talking about, where you're taking from the rich to give to the poor. You're just taking from the rich and just holding on to it, though. That's where we get into an issue. Now, I think they're doing this to stave off refinances, personally. I think that they're trying to protect investors who already have purchased these loans on the secondary market, and they want to hold on to these really nice, interest rates. They're going to get money. If interest rates drop, they're going to be making money. If people hold on and are paying higher than the market, or they've already done their investments based on this, and they want their return, right? So I think that, this is my bigger conspiracy, and I've told Mark this, I've said this before, and I'm okay to go on record about this. I think they're trying to protect the investors a bit and say, hey, if interest rates come down, we are going to have another runoff of refinances. You're already investing in an unstable market, or what might be conceived as an unstable market. We're gonna build in some protection here from you, because it doesn't make sense otherwise. It really doesn't, because this money isn't going. It's not like the FHA prepaid, mortgage insurance premium, where that's going into the fund to protect everybody. This is just kind of sitting in markets and money in people's banks. It's not really a dollar for dollar benefit. And they'll talk around it and say what they're going to do with the money. No one's asking that question. No one's asking where this is going. But it's not like, because it's a little bit more expensive for these one set of buyers, it doesn't mean that the money's given to another set of buyers. And we should be very clear on this. Low credit score does not dictate who you are as a person or how you even treat money sometimes. I have had people who make well over $500,000 a year, really, really high, in their companies. Like they're really great people, financially responsible, good savers, who co-signed on a student loan and the person passed away, and now their credit's tanked. Like, things happen in life, and we don't leave enough grace for that. So them allotting a little bit of grace in those buckets, I'm not upset with. I don't think that they've thought through that some people would look at these charts and go, hey, what are we doing here? It did seem like they wanted to make a nice little shape, and they did that, but the logic behind it is kind of missing.
What's super interesting about this is, and I agree with everything you said, Jazmine, totally. And I think the interesting thing is, so we're being sold this idea that this is going to create opportunity for people who need it most, right? The lower credit score, lower down payment borrower. But there's better options out there. Even with these pricing adjustments, the FHA loan product still kicks the pants off the conventional loan product in that category. So I don't completely buy in that we've lowered a pricing threshold to bring access in. But what I do love about what this has done is it's created a conversation that everybody needed to have for a long time, because these loan level pricing adjustments were put into effect at a time that mortgages were not performing and these GSEs were losing money. That hasn't been the case for a long time. So
that's Fannie and Freddie.
Correct. I'm sorry. Yes. So, and the other thing I guess we didn't touch on yet, these only affect conventional mortgages. So the other mortgage products that are out there for real estate investors who use the DSCR loans, the landlords of the world, the typical investors that utilize products outside of the conventional realm, these don't affect them, and these don't affect the FHA VA loans either, which by and large are better options for those people. So it's a little contradictory when you see the people on the news that are supporting this and saying the justification is that we're lowering these pricing thresholds to create access, which I know a lot of the listeners are being introduced to my voice the first time. but we talk about it all the time. We all advocate for first-time buyers because there's no opportunity to build generational wealth in a family like equity. It's without argument the easiest way for people to build significant pieces of money, or pieces of wealth rather, to pass down to the. So I want to get that out of the way. So we've always been looking for access to capital, and even with these price reductions, there are better options out there. So for me personally, I'm frustrated by all of this, because it feels like we're taking money from the people most able to give it, and they're not willing to give it, which is why all the backlash. But all of that being said, it still costs somebody with a 620 credit score more money on this matrix to borrow 80%, 90%, 90, whatever the percentage is, than it does somebody with a 740 or 780. The things that frustrate me also is we had a top credit score tier of 740, and we've now pushed that all the way to 780. So we're stretching the matrix upward, and then we took the bottom tiers of the old matrix and pulled them all together and put the threshold at 639, I believe it is, or lower.
Yep.
And before those were priced in three other buckets. So we're very arbitrarily redefining risk, and it's not based on creditworthiness or performance, because we should have never been charging anybody as much as we have been for as long, and then to turn the volume up on some and down on others in a market where we've got unprecedented low foreclosure rates historically, right? They've increased, but that's post-COVID when people couldn't foreclose. They have increased, but they're still historically low. We've never had this much equity wealth in this country. We've never had so many people who own their home free and clear, yet we're leaning on a percentage of the mortgage population to pay an additional fee. And I think that's what's got everybody wrapped around the axle.
And they're only there, though, because they're being told. This has been built in and absorbed already. And I'm glad we're talking about it too, so that other people are angry with us. Yeah. Because it's not right. It's not based on any risk. It's we are at low delinquencies right now. And like Mark said, people have equity. Even people in trouble are getting out of their homes and walking away with money. That is a big difference than where we were, a decade ago.
100%. I talk about that all the time. I mean, the money that people put in, they're not easily walking away. Mel, we talked about this recently on one of the shows, before, with the no-doc loans and all that other stuff. People didn't have their skin in the game. So when times got tough, they just threw the keys on the, on the table and left. Now we were seeing people selling their homes, and they were taking $300,000 worth of equity buying their next house. So if things do go a little, lose their job or whatever, it's going to be a little harder for them. I do want to give Sam a chance to talk about investors, but everything you're talking about, I wish we had 2 hours for the show, because a couple thoughts, and maybe we can talk about them on Clubhouse or somewhere else too, because we only have until 7 o'clock. But one is, it was interesting when you brought up FHA. It made my mind go towards, I wonder, because FHA borrowers, we've had such a difficult time getting offers accepted if somebody was doing FHA. So maybe this is a good plan for them to maybe get into something else and make their offers look a little more appealing when they're in a multi-offer situation. The other thing, Jazmine, that you said was about refinance. And I had asked Mark this question. I wonder why, or if the government is slapping themselves across the head right now saying, when we brought the rates down to 2.5% and 2% or whatever, maybe we should have done it just for purchases, but not for refinance, because that, I think 70% of people being in a loan in the United States under 4% right now, that lock-in effect is so strong. There's no reason for anyone to leave.
We'll let Sam talk for sure, but I want to circle back on that. Yeah.
Okay.
No, Mark, I call dibs.
Well, you know what? We can be here next Tuesday as well. And I do want to let our WATD listeners know you are listening to Talk Real Estate Roundtable here this evening. And we have a whole bunch of people here that are our guest, Jazmine Glasgow, as you know, from Maritime Mortgage. She is our go-to girl when it comes to mortgages. We also have Mark Eitel, who is Mr. Mortgage Guy, right?
Yep.
.com, right?
Mr. Mortgage Radio.
Where are you from, Mark? Anyways, what?
We're based out of Florida. My team is nationwide, but I run the company from Florida.
Okay, perfect. That's good to know. So anybody around here who's snowbirding, and we can hook you up with Mark for some of your mortgage questions there. We have Mary and Sam, and we also have Melissa here. Now, Melissa's listening intently because Melissa is in that pool of people looking to try to buy a house. But Sam, do you have some questions or some insight onto the investor part of this?
I wouldn't say they're really investor specific because Jazmine and Mark both hit it on the head. There are other options out there like the DSCR loans, hard money, for example, or private money. And then with the VA and FHA not being affected by this, that's a great first-time home buyer or for someone just starting off in investing to utilize that program. I think my questions were kind of similar to what actually was just asked, which was kind of speaking towards one, I guess, BlackRock. When you hear that name and you see they just landed a fund of $30 or $40 billion to buy single family assets as rentals, is this type of change in the mortgage fee structure kind of, I guess, foreshadowing what's to come and maybe as a way to prevent big commercial investors like that from competing in the space? And then my other question was kind of just in regards to the refinancing versus the purchase aspect, is that, and it was just kind of piggybacking on the previous question.
Yeah, so just to touch on that, this pricing matrix also affects refinances. So any newly originated mortgages are going to go under the new, and to Jazmine's point, these prices are already established, but this is the most recent matrix, so that's in there. And to your previous question about BlackRock, I think if anything that deters, mom and pop, regular people, Joe and Mrs. Public, from wanting to buy, only helps the BlackRocks of the world. So that's why I'm such an advocate of forums like this, where we can educate people to let them know, because people turtle in and they shut down when they read the headlines and they think, oh my God, I'm out of the game. I just saw on the news that it's a 0.75 of a point adjustment for my credit category. And they think rates are already 6 or 6.5. That means I'm at 7. I can't afford that. I'm out, without ever having the conversation. So if people take nothing away from this, there's a lot more data here than just a colorful chart. And it doesn't equate to a number for number increase in interest rate. So to answer that, I think if we do anything as a government or as a society that slows people from wanting to buy, that only is going to pigeonhole more people into renting and allow the big companies of the world to become the major real estate players and buy more single family homes. So I think that might be an unintended result of scaring people away from the market. And then I'm going to shut up and let Jazmine talk.
That makes sense.
Well, also with new construction, Jazmine, too, like that was one of my questions. Mary and I, we have a 92-unit subdivision, and we also have another 40-unit one coming on. And I was talking to Mary about this earlier, and I thought, maybe this will benefit the new construction developers, because of something you said, Mark, on Clubhouse on Monday, when I was like, how am I ever going to explain this to a resale buyer? Because the emotions get into it. But it's very easy to talk to a developer and say, why don't you offer, 3% buyback loan, whatever, buying down the rate.
That's absolutely brilliant. And there was a news piece released on CNBC today that new home sales were up last month. Mm-hmm. As a result, even in the face of interest rates almost clipping 7 during that time period. Yeah. And it's because the new home builder has that profit margin, and they're thinking about it black and white and not emotionally.
Exactly.
And they can buy a rate down. And I'm going to tell you this, and then I promise I'm going to throw the mic to someone else. But I met a gentleman early in my career who built homes in California when interest rates were approaching 18%. And it blew my mind. I grew up in a construction family. My family built single family homes in communities all throughout Florida. And when I met this man, I said, my God, that must have been the worst time ever to be a builder in California. And he said, Mark, I was never busier. And it blew my mind. And I was young. I had no idea what he was talking about. And he said, we put a sign in the front, 4x8 sign, new construction from 12% interest. And he sold the idea that they could buy the rate down to 12% when no one else was doing that. And they had the profit margin built in to do it. Now, that's an extreme example, but a new construction development can say, guys, we'll absorb these LLPAs. And that's all they have to say to get everybody's attention. And if everybody's competing for a 6.5% rate, and the builder can build that margin in to buy it down to 5.75, there's going to be people lining up to buy those homes, especially if the public is pulled back and locked in, as we were using this term, because they've got an interest rate that they're married to and they never want to sell that house again. That puts all the power in the builder's hands to be the number one source of home sales in this country.
Mm-hmm.
But I'll say this, they don't need to go that drastic either.
No.
These changes are not huge. This it looks scary. If you're looking at that chart I shared earlier, and you're in for I don't know if we have a show notes thing or something I can put on the podcast. I can share this. But if you look up LLPA, it'll be the first thing that you'll find on Google, or whatever service you're using. And you can open up the chart, and if you look at that, you're going, oh my goodness, I can't afford, what is this? What does this even mean? It's a bunch of percentages that have already exist. Yes, we have new buckets. Yes, we have increased rates for some, decreased rates for others. We've got a little heat map that shows what has changed, but they're not new. And they're not all drastic changes. And one thing, we're gonna hear this, and this is gonna be noise for a little bit of time. People are gonna be angry again in July when August they start doing the debt to income, which they started to roll that out earlier. There's gonna be an adjustment for debt to income over 40%. Right now, everyone is up in arms in the industry about it, trying to prevent that from going into effect. FHFA said, oh, this is causing anger. So we're going to make all these other changes, let this get through, and we'll start this in August. So we're having this conversation now. We might as well put it on the books to come back in July and re-explain this, because if the mortgage banker side association isn't successful in stopping this, there's going to be another rollout, another quote unquote tax for home buyers, regardless of their down payment and credit score. It's going to be there pretty much if you're borrowing more than 40% and you have a debt to income over 40%. And so this is going to exist, and people are going to get angry about it. But like I said, that example I showed earlier, for a $500,000 purchase, $400,000 loan amount, for some people that changes $1,000
in closing costs.
In closing costs.
Yeah.
It's not the same rate.
Yep.
$1,000 more expensive, right? If $1,000 is the barrier to buying a home when you're already putting down $100,000, when have you let 1% of anything stop you from your dreams?
Well, you shouldn't be buying the house,
Right. But you're already putting down $100,000.
Yeah, so an extra $1,000 shouldn't make a difference. Yeah.
You just said something,
and I'm not. Yeah, sorry. Go ahead.
No, you said something super powerful, and this I keep holding this up, and it looks like a hurricane going over Florida, and I'm in Florida, so we got the red and the green and the yellow, and the red is the scary part, and that's got everybody scared. But I can't tell you how many times the red band of a hurricane comes right over your house and you don't even know it happened. And that analogy just jumped in my mind because Jazmine mentioned these are already priced in right now, and you don't know that red hurricane band is your bucket because you haven't seen it called out like this before. It doesn't make it right. It just makes it it just makes it tolerable because we're not aware of it. And that, again, doesn't justify it, but suddenly this map has called everybody's attention to it. And I didn't mean to interrupt, but when you said that, I had to use that weather analogy.
No, and it's good because people don't know what they don't know. And right now we're in another fear cycle. You know, we're hearing there's another barrier and you're working on your credit score. I just listened to someone earlier today who were saying, well, this is what you want to do. You want to be late on a credit card. I was like, whoa.
They said that on the news, Jazmine, yesterday.
Crazy.
I was watching local news, Channel 4. I hate to call anybody out. I think it was Channel 4. And they literally said that. The two, I've never seen commentary like that between two of the people on the desk. And he said, well, maybe I ruined my credit score. And I'm like, oh, no. I heard Mark this morning and he said you don't want to do that.
You're still better with a higher credit score in all situations.
Yep.
In all situations. And you might, if you're in a really large loan amount, you might be strategic and you might, borrow more at closing and then recast and put the additional down after closing. We're having those conversations with people. Most people aren't taking the hassle to save money. This has been happening. These loan level pricing adjustments are how interest rates get from Fannie Mae, Freddie Mac to your table, right?
Well, and Jazmine, You said that, and if we leave anybody with two things tonight, one is I want everybody who is confused about this to have a conversation with your person. And if you're anywhere listening tonight, Jazmine and the Boston Connect team, they can answer your questions. Have the conversation. But number two, there's strategies for these things. You just mentioned a great point. At a certain threshold, it's going to make sense to maybe put a little bit less down and then recast the loan, which simply means you make a one-time larger principal-only payment that reduces you now back down to whatever your original goal was. And if it's a mortgage insurance component, then you lose the mortgage insurance because you're now back under 80%. So that's why if we can encourage anything tonight, it's to take these conversations off the air, because whether it's a 3/4 of a point adjustment to the best bucket on the map, or to Jazmine's point, it's $1,000 additional in closing costs or $35 or $40 additional in a mortgage payment, it's not going to stop you from coming up with a strategy to make it happen. And don't tank your credit, because the low credit score still pays more fees and a higher interest rate, even under these adjustments, than a high credit score.
Do you, are both of you available maybe next Tuesday? Do you want to continue on? Because we do have 1 minute left. So do you think you have more? Okay. Because David Tortolot, who you may know, Jazmine, he does reverse mortgage. Yes, and we have him on here as a guest with us all the time. He just said, great show, Sharon. Currently, there is $12 trillion in unused equity lying in people's primary homes just age 62 or older nationwide. So I don't know what his thought is about that, but I think it's fascinating, I guess. David's very smart, too. So maybe we can ask David to join us, too, because maybe there is a piece that goes with reverse mortgages as well.
Well, those aren't impacted by this, but he's a pro. And anytime anyone can learn anything about reverse, I technically on paper do them. I send them to Dave.
Okay, perfect. I am so sorry that we have to go. Mary and Sam, next Tuesday, we're going to let you talk, and Melissa and Mark. Thank you so much. Jazmine, you guys are the best. Thank you, everybody, for joining us. BostonConnect.com. We'll be putting this on our podcast, Talk Real Estate Roundtable, as well. Melissa and I will be back here on Saturday from 10 to 11, so we hope that you can join us then.